If you watched my previous video on the weighted average cost of capital without tax, you could have wondered what is the impact of tax on business financing, because we know that all businesses actually pay tax. My name is Dr. John Yamunda, and today we are going to talk about the weighted average cost of capital including tax. In our previous conversation, we had an example of Ashika Investments, where it was financed 50% by ordinary shareholders, 30% by preference, 20%, and we said there was no tax. So the weighted average cost of capital was simply 0.5 times 16, which was the first line, 0.3 times 14, and 0.2 times 6, because we didn't take account of tax. So our answer was 13.4. So what is the impact of this tax I keep on talking about? So to take into account of tax, we need to first pause and reflect on how our income statement looks. So we know that ordinary shares and preference shares receive dividends, and dividends are an after-tax expense, whilst interest on loans or debentures is a before-tax expense. So how do we incorporate that in our calculation of the weighted average cost of capital? It's simple, my friend, because we are only going to make one small tweak to our previous calculation. We are going to say 0.5 times 16, no change there. 0.3 times 14, no change there, but now comes the change. We are going to say 0.2 times 6 times 1 minus 0.03. Why 1 minus 0.03? Because the tax should reduce the cost of interest. So we are saying 1 minus 0.3, so that we reduce that 6% by 30%. Okay, I'm talking too much. So then it becomes 0.5 times 6, no change, there no change, but 0.2 times 6 times 70%, or times 0.7. 0.7 is 1 minus 0.3, gives you 0.7, which then gives you 0.1304, which is equals to 13.04%. If you rewind a little bit, you will see that this answer was 13.40. It has reduced because of the benefits which interest enjoy from being a before tax expense. This whole conversation is pointless unless if you do your own question. So pause the video and do this question from Teboho, Cash and Carry. Pause, do the calculation, and join me in the next slide. I am confident if you did it slowly, my friend, you would have found your answer as 14.95, because you would have said 0.6 times 18%, which is the cost of ordinary shares here in the weight, 0.2 times 15, weight and cost of preference shares, 0.2 times 8 times 72%. Why 72%? Because the tax is 0.2 is 28%. So if you say 1 minus 28%, it gives you 72%, or 0.72, which gives you 14952, which is 14.95%. So what did we say today? We said all businesses pay tax. So when we are doing the weighted average cost of capital, we have to reduce the interest expense with the tax the business is going to pay. Thank you for joining in today's discussion on weighted average cost of capital including tax. Goodbye.